Intel surged 14% on Tuesday, a $62 billion single-session gain, while the rest of the chip sector was busy parsing AMD's quarterly numbers. That asymmetry is the starting point. Tuesday was a heavy earnings day. AMD reported Q1 revenue of $10.25 billion, beating consensus by $360 million. Data center revenue hit $5.8 billion, up 57% year-over-year. AMD stock rose 6%, which in any normal week would dominate the semiconductor conversation. It did not dominate Tuesday. The Nasdaq 100 climbed above 28,000 for the first time. Intel shares crossed $109, and the question that consumed the trading floor was not about AMD's beat. It was about a Bloomberg report that Apple had opened early discussions with Intel about using its Foundry services for future U.S. chip production. The Nasdaq's move to 28,000 had support from multiple directions. Qualcomm, which had already disclosed a hyperscaler AI chip win in late April, was up 12% again on follow-through buying. Alphabet was up 1.4% after an analyst upgrade, partly boosted by a separate report that Anthropic may account for more than 40%.
The Foundry question is the one that makes Tuesday's Intel move legible. Apple sources nearly all of its leading-edge chips from TSMC. That arrangement has worked for over a decade. The A-series and M-series chips that run iPhones, iPads, and Macs are built in Taiwan. The geopolitical exposure embedded in that supply chain has been visible for years, but Apple has not moved. The Bloomberg report says that has changed, that Apple is now in early discussions with both Intel and Samsung about manufacturing alternatives for US-based production. The signal matters because of what it validates. Intel's 18A process node, the manufacturing technology it has been developing under its Foundry turnaround strategy, has been skeptically received by the market. For the past 2 years, the question surrounding Intel Foundry has been whether any major customer would actually trust it with advanced production. A hyperscaler or a smartphone OEM committing volume to 18A would answer that question. Apple is not a hyperscaler. It is the world's largest buyer of leading-edge chips by volume. If Apple is visiting Intel's fabs and walking Samsung's Texas facility, it is not doing it for curiosity. The cross-domain element is what creates the size of the move. Intel's prior rally, the stock is up 197% year-to-date, was driven largely by its own earnings beat, its partnership with Elon Musk's Terafab initiative, and short covering. Those were Intel internal catalysts. Tuesday's catalyst comes from outside, a customer decision driven by geopolitical risk pricing, U.S. manufacturing policy, and supply chain diversification. That is a structurally different buyer. It implies recurring volume, not a one-time design win. The market is pricing a scenario where Intel becomes the domestic foundry alternative for companies that need to reduce TSMC concentration risk, and Apple is the most credible customer that could confirm that scenario exists. The reversal condition sits directly inside that logic. Apple's discussions are described as early-stage, exploratory, and unconfirmed. Intel's 18A node has not yet been validated in mass production at the volumes Apple would require. TSMC's Arizona expansion is accelerating. Apple could achieve partial US-based production through TSMC without switching foundry partners at all. If the Bloomberg report's framing overstates the probability of a deal, Tuesday's 14% move was pricing a future to remain speculative. Intel stock has now tripled year-to-date. The margin for disappointment is not small.
The historical parallel worth examining is TSMC's own foundry transition moment. In 2020, when TSMC announced its Arizona fab investment and began winning U.S. government backing, the market's initial reaction was to price the geopolitical hedge as a permanent feature of the semiconductor landscape. That pricing proved directionally correct, but the timeline stretched years beyond early estimates. Costs overran, and the anticipated volume commitments from U.S. customers came in slower than projected. The stock that benefited most in the near term was not TSMC itself, but the suppliers adjacent to the new fab build-out. Intel is now in a structurally similar position. The narrative is right, the direction is credible, but the execution timeline is the unresolved variable. The 18A node needs a production-scale validation customer. If Apple signs or even signals a letter of intent, the current valuation finds support. Intel's $500 billion market cap implies the market has already given significant probability to that outcome. The verification benchmark is straightforward. Any confirmatory disclosure from Apple or Intel about foundry discussions, an 18A design win announcement, or Intel's next earnings call guidance on foundry revenue trajectory. The breakdown scenario is equally concrete. If Apple's next earnings call or supply chain disclosures show continued TSMC concentration with no mention of domestic fab diversification, the Apple-Intel narrative loses its anchor. Qualcomm's hyperscalers ASIC ramp, now confirmed for Q4 2026 shipment, offers a reminder that chip design wins can move fast once confirmed, but the gap between early discussions and confirmed volume has historically been wide. Evidence so far tilts towards Intel's Foundry narrative having real momentum, but only while the Apple conversation remains active and 18A production readiness keeps pace. If Apple's timelines slip, or if TSMC's Arizona expansion absorbs the fab demand that Intel is counting on, Tuesday's 14% becomes a sentiment peak rather than a valuation re-rating. The question the market needs answered by Intel's next quarterly call is whether 18A has a named customer with committed volume, or whether Tuesday was priced on a Bloomberg report that never converts. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.